And because we have been speaking about it, Gold Coast, your thoughts on those two?
Brisbane, I think I just mentioned it there because speaking about the sort of Perth change-up, again, another universal test to run. And obviously there's always anomalies. There's always exceptions that fall out of favour. I'll name an easy one would be Christchurch, which since the earthquakes has never really recovered. But that will recover its rightful place. The old test I refer to is that if you're the third largest city, you should be the third most expensive city. It's the general way it works. So now with Brisbane where it is at the moment, I fully expect. Now I don't expect it to go to levels that are commensurate with where Sydney and Melbourne has got in regards to even with a slice off it, with regards to the froth that Sydney and Melbourne have encountered at all, because we will be moving into a higher interest rate environment, if not at least investors factoring in increased interest rates. But what one has to remember is that these figures, as not only is Brisbane Australia's fastest growing city, those figures are expected to be maintained from the Bureau of Statistics. So a really good, I suppose, vault of expectation there to 2030. So whether that happens to be right by 2032 or wrong by 2028, it's not really the point. We've got 15 years between there. So with that trend in tow and prices at an average of $490,000, $500,000 for Brisbane, yet wages only 12% lower than Sydney, there's a lot of room for growth there.
Gold Coast then?
Look, Gold Coast, that's obviously the perennial, sorry, not the perennial, the deciduous trade. It comes once a cycle, and be thankful when it comes around. The biggest mistake people make with Gold Coast, Adam, is the fact that when Gold Coast booms, and it booms good, they confuse a bull market with their brains. And that's the lesson now that I'd probably want to put, and certainly I've got it deep-seated in my roots, I'd want to get it into my clients, and I think I have. But any other investor that wants to make that play is not to mistake the fact that they got in at the bottom of the market. They can sell that at the top of the market, which they shouldn't entitled to do. But it's amazing how when market rallies, either up or rallies down, everything gets distorted. And all of a sudden they make those decisions to buy another 5 properties in the Gold Coast at a boom. So if that message could get through, and it's just that don't confuse a bull market with your brains and have a bit of humility about that, I think then you can actually separate yourself from that transaction and say, I set my price and I buy in at 400,000 with full expectation that this may well hit 650,000. But if you set your trade out and you trade out at $580,000 as a return on investment, you know, as opposed to just a pure increase in percentage, return on investment, that's a great move. And you're talking 200, 300% in a matter of 2.5, 3.5, 4 years.